Listen closely because today we're treating this explainer like a high-stakes one-on-one mentoring session. I'm going to give you the exact blueprint that seven-figure traders use to literally see inside the market. If you're an ambitious student of the markets looking to seriously elevate your edge, well, you're in exactly the right place. Okay, let's dive right into this. Now, if you've been trading for a while, you've absolutely experienced this. You draw your zones, wait for the perfect technical setup, you enter the trade, and then, boom. An invisible hand seemingly comes out of nowhere, stops you out by a single tick, and then the market just rips in your intended direction. It's incredibly frustrating, right? And that's exactly because trading with just standard price charts and candlesticks, it's essentially like trading completely blind. You're just looking at the shadow of the market, not the actual moving parts. So here is our masterclass syllabus for this session. We're going to start with the order flow edge, break down market auction mechanics, and then spot those sneaky institutional stop traps. After that, we'll walk through the CLC trading framework, execute some high reward setups, and finish up with the exact daily drills you're going to need for absolute mastery. Section 1, the order flow edge. Now, the absolutely crucial point here is that we are not throwing away your current toolkit. I definitely don't want you abandoning the technical analysis you spent years perfecting. Instead, as our source material from a verified seven-figure trader emphasizes, order flow adds an undeniable layer of high-quality confirmation to whatever strategy you already use. Whether you trade ICT, smart money concepts, Fibonacci, or just basic supply and demand, order flow is the ultimate validator. To put it simply, order flow is the underlying auction mechanics, showing completed transactions between passive and aggressive market participants. Think of it like a giant X-ray. It cuts right through the noisy shadows of line charts and candlesticks and shows you the actual verifiable participants moving the market right this second. You're no longer guessing if a support level is going to hold. You are watching the literal volume of buy and sell orders battle it out in real time. Moving to Section 2, Market Auction Mechanics Explained. So the market is driven by two distinct types of participants. First up, you have passive participants. These are the traders placing limit orders, adding liquidity to the bid or the ask. They're essentially saying, hey, I'm willing to buy or sell, but only at this exact price. On the flip side, you have the aggressive participants. These traders are using market orders, aggressively hitting the bid or the ask to execute a trade instantly. For any transaction to happen, an aggressive market order literally has to hit a passive limit order. And what that means is the aggressive participants are the ones giving us the actual immediate intention of market direction. Let's use a really brilliant real estate analogy from our source to make this all click. Imagine you list a house for $100,000. That is a passive asking price. But a buyer comes along and bids $90,000. That's a passive bid. Now, let's say your house sits on the market for months. You get a bit impatient, so you accept the $90,000 bid. You just became the aggressive seller. You aggressively hit their passive bid, the transaction was completed, and you effectively drove the market price of that real estate down. The financial markets work the exact same way, just at lightning speed with millions of transactions. All right, Section 3, Spotting Institutional Stop Traps. Here's exactly where retail traders get trapped. Look, institutions need massive amounts of liquidity to enter their giant positions. They can't just click buy without moving the market entirely against themselves, right? So they accumulate during tight consolidations. Then they use order flow to push the price just past psychological support or resistance levels. Why? Because that engineered false breakout triggers your stop losses, creating a massive flood of automated sell orders. The institutions step in, passively absorb all of your stop-loss selling to build their massive long positions, and then, boom, the market aggressively reverses away from the trap. Now, this brings us to a major complaint people often have about order flow: spoofing. Spoofing is when massive, fake limit orders are placed just to scare the market, but then they're pulled before they ever execute. Your checklist for spotting spoofing is actually really simple. Fake limit orders are pulled before execution, and they print absolutely zero volume on the volume profile. Authentic institutional participation, however, prints undeniable aggressive volume. You simply cannot fake a completed transaction. And that brings us to the concept of absorption. While retail traders are out there drawing blind support lines and just crossing their fingers that they hold, order flow shows us actual, verifiable absorption. This happens when thousands of aggressive market sell orders flood into the tape, but the price literally does not budge. Why on earth wouldn't it move? Because a massive institutional passive order is sitting right there, absorbing every single aggressive sell order like a giant sponge. When you see aggressive selling fail to drop the price, you know a massive reversal is brewing. Section 4, the CLC Trading Framework. So CLC stands for context, location, and confirmation. Listen, you should never, ever trade random spikes in volume right in the middle of a consolidating range. First, you absolutely must define the context. Like, are we trending, ranging, or sweeping liquidity? Second, you wait for the price to hit a precise location. Think major Fibonacci levels or historical supply zones. And only then, third, do you use order flow as your absolute confirmation to actually pull the trigger. When price reaches your chosen location, you watch for that aggressive volume to stall. Specifically, you want to look for a P-shape or a B-shape volume footprint on your charts. A P-shape at a high indicates heavy volume was transacted, but aggressive buyers are now trapped because the price is rejecting. You enter exactly when the order flow proves those impatient retail traders are officially trapped on the wrong side of the momentum. Section 5, executing high-reward setups. 8-1, that's incredible, right? By using order flow to validate the exact turning point of a reversal, our source case study pulled a massive $35,000 profit on a single trade, using an incredibly tight 8-1 risk-to-reward ratio. When you aren't just blindly guessing where the bottom is, your win potential absolutely skyrockets compared to the capital you're risking. Because order flow lets you see exactly where that institutional absorption is taking place, you can set your stop loss right where that validating volume fails. Your risk box shrinks dramatically, and when your stop loss shrinks from, say, 10 points down to 2 points, you can exponentially increase your position size while keeping your actual dollar risk exactly identical. Guys, that is the real secret to scaling up safely. But execution requires a serious mindset shift. You've got to stop waiting for standard 5-minute candles to close. Time doesn't move the market, volume does. If you wait for a candle to close, the move is often already over and your risk to reward is completely ruined. You must enter exactly when the validating volume hits the tape. From there, manage your live trades by watching real-time aggressive pressure and adjust your exits directly into historical low-volume nodes. Those are areas where price easily gravitates simply because there is zero resistance. Section 6, Daily Drills for Mastery. As your mentor in this explainer, I am definitely not letting you leave without your homework. Order flow reading is a muscle, and it requires targeted repetition. To sharpen your recognition skills, your daily practice drill is to record your trading screens. Then, use market replay tools every single weekend. You need to actively rewatch the order flow tape of the trades you lost, and honestly, just as importantly, the order flow of the perfect setups you completely missed. You'll quickly see what absorption and trapping look like in hindsight, so you can execute on them flawlessly in real time. This brilliant quote from our source material really hits the nail on the head and highlights the ultimate lesson of this entire explainer. You cannot predict the future. Trying to predict the market is a fool's errand. But with order flow, you don't have to predict. You can react perfectly to the undeniable present. You wait for the trap, you see the volume confirm the trap, and then you react. So, now that you have the blueprint to see through the shadows, expose the real auction mechanics, and spot institutional manipulation before it absolutely destroys your account, the ball is in your court. The only question left is, when will you stop trading blindly and start reading the market's true story? Thanks for tuning into this explainer, and keep grinding.